Welcome to Stress-Free Investing Analysis, Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. All right, let's jump right in. Today's explainer roadmap covers the Mold-Tek story, current headwinds and risks, the growth catalysts, financial forensics, and finally, valuation and verdict. Section 1, the Mold-Tek story. So Mold-Tek isn't some flashy new startup, right? They've actually been a rigid plastic packaging leader in India for 40 years now. But what's really interesting is that they're actively transitioning their business toward a high-value product mix. And this is entirely driven by their core economic moat, which is called IML, or in-mold labeling. Think about it. Instead of just slapping a cheap sticker on a plastic bucket after it's manufactured, IML technology actually fuses the label directly into the container right during the molding process. It looks incredibly premium on the shelf. But more importantly for us as investors, the mold tooling is customer-specific. That creates massive switching costs. If a client wants to leave Mold-Tek, they're looking at a 6 to 12-month supply chain disruption. That effectively locks them in and allows Mold-Tek to charge a solid premium. So who exactly are these locked-in customers? Well, a massive 44% of their revenue comes from the paint sector. Think industry giants like Asian Paints. Another 30% comes from lubricants and 15% from food and FMCG. But I want you to pay very close attention to that tiny 4% slice dedicated to pharma. It looks totally insignificant right now, but as we get deeper into this explainer, you're going to see exactly why that tiny little slice is the absolute key to the future of this entire company. Section 2, current headwinds and risks. Now, before we get to that bright, shiny future, we have to address the elephant in the room. Why has the business been bleeding lately? This is the central mystery we really need to solve today. Why is a high-quality market leader with a fantastic technological moat currently trading a staggering 38% below its all-time high? The data points us straight to two major culprits. First up, let's look at their cash flow. If you compare cash flow from operations to capital expenditures, their CAPEX, it reveals a pretty tough truth. Over FY24 and FY25, their CAPEX heavily outweighed the actual cash they were bringing in from operations, and that led to negative free cash flow. Basically, they've been stuck in an aggressive CapEx supercycle, just spending heavily to build out new plants. And because those plants haven't fully ramped up production yet, it's temporarily destroyed their incremental economic value. It actually drove their return on capital employed down to just 12.4% in FY25. As you probably know, the market absolutely hates negative free cash flow, and the current stock price totally reflects that. The second big risk? It's right there in their lubricant segment. Remember how that made up 30% of their total revenue? Well, volumes there dropped 13% in FY26. And this isn't just a temporary dip either. It's a structural, secular shift. Huge corporate clients like Castrol and Shell are actively moving away from individual retail pails and shifting toward bulk drum packaging to save on costs. When nearly a third... Section 3, the growth catalysts. Okay, so they've been burning cash and their legacy business is shrinking. Sounds terrible, right? Well, here is the cure. Boom, over 200% growth. This is the massive volume growth we saw in FY26 coming from that tiny little pharma segment we flagged earlier. Mold-Tek has successfully secured approvals from 26 brand new pharmaceutical clients, and they are scaling this specific segment at an absolutely blistering pace right now. And here's exactly why that massive growth matters so much. It's all about the profit margins. The corporate average profitability for Mold-Tek is roughly 40 rupees of EBITDA for every kilogram of plastic. But that new pharma segment, that commands 90 to 100 rupees of EBITDA per kilogram. It's literally more than double the profitability. As pharma continues to scale up with those 26 new clients, it's going to dramatically pull up the overall profitability profile of the entire company. It's a real game changer. But pharma isn't the only thing pushing them forward. We have some serious additional catalysts lining up for FY27. First, Grasim Industries is aggressively expanding into the paint sector and disrupting the whole market. Mold-Tek is providing their packaging, and Grasim volumes were already up 60% in FY26 alone. As Grasim scales from 8 up to 40 plants, that's a massive structural tailwind for Mold-Tek. And even better, remember that brutal CapEx supercycle that was crushing their cash flow? Management is guiding that CapEx will drop drastically from around 140 cores down to just 80 to 85 cores in FY27. With CapEx plunging and high margin revenue scaling up, free cash flow is finally guided to turn strongly positive for the first time in years. This is the exact inflection point investors dream about. Section 4. Financial Forensics. Now, before we get too carried away, we always need to verify that the underlying accounting is clean, especially during a messy transition phase like this one. Our forensic scorecard paints a pretty reassuring picture. The Piotrowski F-score is sitting at an average 5 out of 9, which is entirely expected because that heavy CapEx has temporarily depressed their returns. But more importantly, the Altman Z-Score, which measures bankruptcy risk, is at a rock-solid 12.3. That puts them well into the safe zone. Finally, the Benesh score, which flags potential accounting manipulation, is at a negative 2.55, proving the accounting is totally clean. And if you need more proof of their earnings quality, just look at this. The cash flow from operations to profit after tax ratio in FY25 was an incredible 1.80x. This is a remarkably strong signal for us. It basically means the profits Mold-Tek reports on paper are absolutely backed by cold, hard cash actually flowing into the business. There are no accounting shenanigans happening here. The headwinds they're facing are simply business cycle issues, not forensic red flags. Section 5, Valuation and Verdict. So we've seen the risks, we've seen the huge catalysts, and we've verified the financials. What is the market actually pricing in? If we do a reverse discounted cash flow analysis at the current price of around 700 rupees, we find that the market is essentially pricing in zero growth from FY26 levels. Just think about that for a second. The market expects literally zero growth, yet management is explicitly guiding to hit 1,000 crores in revenue by FY27. Because expectations are currently sitting on the floor, any execution on these growth levers creates a fantastic setup for upside. Which brings us to our scenario targets. If things go wrong, say the lubricants decline, accelerates, and pharma scales much slower than expected, our bear case is 530 rupees, representing about a 24% downside. Our base case, assuming they simply hit their FY27 targets and free cash flow turns positive, is 780 rupees, giving us an 11% upside. But our bull case, where pharma really takes off and the market re-rates the stock for those higher margins, targets 1,050 rupees, a massive 50% upside. This gives us a highly favorable risk-to-reward asymmetry of about 1.9 to 2.0x upside compared to the downside. So what's the final verdict on Mold-Tek Packaging? For us, it's an accumulate. It scores a solid 57.7 out of 100 on our stress-free investing scorecard, earning a grade C+. The core thesis here is that this business is standing right at a major inflection point. But because they are still very much in transition, the smart move is a staggered entry. You want to buy in tranches rather than going all in right away. Keep a close eye on their FY27 quarterly results to confirm that they are actually dropping that CapEx and officially turning that free cash flow positive. With so many companies out there hiding poor unit economics behind flashy marketing, it really makes you wonder, how many other boring packaging companies are quietly building massive economic moats right under the market's nose? Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below and it might be the subject of my next video. Thank you for watching and keep your investing stress-free investing.